Hi, good afternoon. This is May Valensky with Driving Markets, your weekly podcast. So let's discuss today Japanese bonds and US bonds and the impact it will have on financial markets. So the Japanese bond auction that took place recently in Japan by the Bank of Japan on several notes. They were the 20-year Japanese bond, the 30-year and the 40-year. Now the 30-year and 40-year had zero, yes, zero, listen to this very carefully, zero investors and zero traders were willing to take up the Japanese bond of the 30-year and 40-year long-term interest-bearing bond. On the 20-year bond, the primary issuers, there's primary issuers and there's secondary issuers. In other words, the first layer of banks that promised to offload and sell these bonds had to buy back 70% of those bonds as a guarantor to the Bank of Japan that these bonds would be sold. In other words, in simple language, there's no one interested in Japanese bonds, and the Japanese bond price has tanked. However, markets have not reacted in a way that I would have thought they would react, and maybe it's the news has to filter through for this to impact financial markets. So what exactly is the issue with the Japanese bond market? So if you listen carefully, you will catch some very significant fundamental information. So the Japanese loan to GDP, debt ratio to GDP, how much debt they're in relation to how much the country can produce, is running at 263% against a GDP of 100% max. In other words, the Japanese government can never catch up with GDP paying off its debt. And the Japanese have, being the third, number three global economy, have successfully managed to issue debt over the last 40, 50, 60 years with no problem. In fact, Japan is seen, or was seen, as one of the safest economies and the safe haven across the board on its currencies and on its bonds. And now that Japan cannot sell its bonds is an extremely worrying sign for financial markets and the bond market. If no one is willing to invest or buy the Japanese bonds, then that would cause the price of those bonds to crash. Now, Japanese bonds are being bought up mainly by domestic investors in Japan who've been buying government bonds and by pension funds in Japan. Now, Japan has invested around about 1.5 trillion US dollars in the American stock market and other financial instruments. And Japan plans to repatriate that $1.5 trillion back into Japan. That means they would be selling US dollars, there'd be a carry trade, they'd be selling US dollars, and they would be buying yen. So in this particular case, where you've got falling bond prices and rising yields, which means you get a better return on your money, not only will Japan cash in its US dollar denominated assets and reinvest those back in its domestic market, therefore buying yen, you'll also have foreign investors, traders, and other institutions that will be looking to get a higher return on Japanese bonds, and therefore they'll be buying yen in order to invest in those Japanese bonds. However, on an economic basis, Japan is at crisis stage or meltdown stage. What does that mean? It means they've got the worst situation than Greece had in 2012 that defaulted on 75% of its loans. And now you have Japan, which is in a far greater debt situation than Greece, that could default on its loans, and therefore yields have shot up in order to compensate investors who will take the risk of buying Japanese bonds with a higher yield. How does this reflect on the US? So if we look at the US, which is the number one global economy and the number one issuer of global bonds, of US treasuries and global bonds, then their debt ratio of debt to GDP is 125%. So it's much lower and better than Japan. However, with the US issuing $2 trillion of new debt every year, they are on a runaway steam train that's going to take off and crash. Even though Trump has vowed and promised to cut government debt and reduce government borrowing, he won't have the chance to do that because Congress is still fitting in and establishing the way forward on its old rules. Whether Republican or whether Democrats, Congress is authorizing the issuance of new debt. And that is a contradiction or contrary to what Donald Trump wants to achieve, which is a cancelling of debt. Meanwhile, the Congress has upped the debt ceiling by 5 trillion, and this caused Moody's, the rating agency in the US, to downgrade US credibility. However, if you were to dig a bit deeper on Moody's, this is the first downgrade that Moody's has done in the United States. They never did one back in 2010 banking crisis. They never did it at the dot-com crisis. They never did it in the 1980s. They never did it in 1944 when the US had equivalent today of 10 trillion extra debt. And they never did it in the 1929 Wall Street crash. However, they have done it 4 months into Donald Trump's presidency, which would smell like or indicate that they are anti-Trump and have just taken the first downgrade in over 80 years as an opportunity, or 100 years, to downgrade the US while Trump is president. But they've never downgraded any other event or crisis in the last 80 to 100 years, which to me smells of a suspicious action. However, if you want to remain objective, Moody's has downgraded the US, and therefore that has sent the 30-year US Treasury yield above 5%. It's actually 5.01%. That means, quite simple, that the long end curve, or the long end understanding or estimation of interest rates in the US, which normally should be lower, now is higher, is indicating that inflation is here to stay, and therefore bond yields, the amount of money you get on a bond per annum as an interest rate payment, is rising or staying very high. As a result of that, that's going to attract people to go into bonds more than go into US stocks or other assets. So what is the counter? What's the contra to the Japanese bond crisis and the potential US bond crisis that's going to come like a tsunami that's going to hit the whole of the West, starting with the US? So the contra to that is gold and Bitcoin. So gold is non-inflationary. Gold is a scarce metal. It's non-central bank governed, it's decentralized, and no one can manage it or manipulate it. So you will see gold go up significantly over the next year, 2 years, as a contra to the banking bond vigilante crisis that's going on, that is going to downgrade Japan and potentially downgrade the US, where gold will not be downgraded, and therefore you could see gold running in 2 years' time at about $7,000 an ounce, which is still cheap in relation to what I really think it should be, is around about $10,000-12,000 an ounce. So gold is the asset to go to in times of this crisis, and this crisis is only going to get deeper. It's not going to get lighter because Japan cannot pull itself out of this continuing debt issuing, and it has an aging workforce, and it can't afford to lower taxes, because it was to lower taxes would have less revenue coming in, and then have less revenue coming in order to pay the debt that is issuing. So Japan is the number one issue. That is the fuse, and the bomb is the US. If government spending is not cut dramatically, then it's a matter of time, on a time bomb, before the bond market will explode. Yields will go to 7-8%, and bond prices will fall, and that will cause gold to go up to $7,000, $8,000, $9,000 an ounce, and Bitcoin to hit around about $250,000 a coin. Stock markets would react negatively. However, in light of the poor bond issue by Japan, it looks like the stock markets for the moment have ignored the fallout from the Japanese failed auction, and they probably want to see the next auction, how the take up is on that before they start moving. But as per usual, the stock markets are always lagging behind the major news. Therefore, it may be a while before we see stock markets correct in light of a Japanese failed bond market and a US failed bond market. You can catch this on any of your favorite platforms for podcasts. This is Mayor Valensky with Driving Markets. You can visit us on the website drivingmarkets.com, or you can join up for the mentorship if you so wish. Have a good day.